Equity hedge funds suffer historic declines in the first 5 months of 2022. Now, this is the worst year for hedge funds in the last 32 years. So before we get into this article, before we look at the technical analysis on AMC stock, the Stock Tracker data, and look at what has changed on the Ortex data, I do want to read this article and remind you guys that when you're thinking about AMC, I think there's a couple things I just want to address here in the start of this video. There's a couple factors that make AMC possible, right? This MOAS. It's the Ortex data, obviously, the short interest. It's also are retail investors going out and buying stocks? Is there FOMO in the markets? And clearly, look at something like Redbox. Look at some other stocks that have rallied massively in 2022. You're talking from, say, $10 to $100. There's multiple stocks I could list you guys right now and essentially would prove that retail investors are here. FOMO is here from retail as well as hedge funds and institutional buyers. Now, on top of that, the biggest thing you must consider, and this is something that a lot of other AMC creators never talk about, it's where are market hedge funds at? In other words, is it harder or easier now to service a margin call rather than in the past? And the overwhelming answer is yes, it's harder to service a margin call now than over the past year. Interest rates are much higher. Portfolio values are destroyed, right? It's a lot harder to service that same margin call if you have had your margin debt at the same level. And that's exactly what has happened. The margin debt really has not fallen really that much at all. You're still at over $700 billion for total margin debt that is outstanding. So obviously, hopefully this makes some sense to you guys. And if you do look at the margin debt, just so you guys are aware, you're sitting at $772 billion for margin debt. You're much higher still, about $350 billion higher now than we were during the crash of 2020. But servicing that margin debt is a lot more expensive now. So that's what I wanted to throw in here in the beginning of this video. Now let's get into all of the other information that you guys want to know. If you guys want to come trade with me live in real time, link down below in the pinned comment. We had some SPY June 17th 390 puts that actually went in the money. Bought those for $100 a piece, cashed out at about $700. Same thing with the QQQ. I believe it was the 280 puts. That was about $100 into $650. And then multiple contracts. So extrapolate that how you guys want. And then we had some killer trades on Redbox as well that I think will do well in this next upcoming week. So if you guys want to be a part of the action over there, link down below in the pinned comment. Obviously, your returns are not guaranteed, but it's a great community to be a part of and to source information and trading ideas. And make sure to get your free stock down below in the description of this video with Webull, Moomoo, and Public. Now, let's dive into the key information here in this video. We're going to go ahead and read part of this article and then dive into the information directly related to AMC stock. So, equity hedge funds suffer historic declines in the first 5 months of 2022. Shifting market dynamics create existential crisis for some stock strategies. It says, this is shaping up to be the worst year for equity hedge funds on record, in a sign that they are struggling to adjust to a dynamic change in market conditions. Equity hedge funds, which manage about $1.2 trillion in assets, lost 8% on average in the first 5 months of 2022, according to data group HFR. This outstrips losses in other years marked by crises. On HFR data going back some 32 years, and leaves hedge funds with a huge task to recoup losses over the rest of 2022. The opening 5 months of 2020, which brought a huge drop in stocks following by a volatile recovery, left funds down 5.8%. Equity hedge funds are generally having a really difficult time. It feels worse for that strategy than in '08, said Anthony Saramushi, founder of New York-based investment firm Skybridge Capital. So essentially what this says right here, hedge funds during 2020, in the first 5 months, were only down 5.8%. They're already down 8% on average. So some hedge funds like Tiger Global are down 52%. Melvin Capital completely shut down. Lone Wolf, a lot of other hedge funds are down, 20, 30, 40%. And it's a really bad situation for a lot of hedge funds out there. That's just the honest truth. And that's what makes margin calls a lot easier to actually get, and that's where you can get the forced liquidations, especially if a stock like AMC becomes a lot more risky to have a short position on than not. So let's continue on. It says this year's losses are milder than the 12.8% fall in the benchmark S&P 500 index of U.S. stocks, including dividends, but the supposed investment acumen of the sharpest investors in the market is still leaving holders in a hole. Such heavy losses at hedge funds can easily become self-fulfilling as hedge funds take losses and customers ask for their money back. Often they are forced to sell holdings regardless of whether those bets are performing well. This can contribute to volatility and deepen market declines. The loss among equity funds stand in stark contrast to the performance of much of the rest of the $4 trillion hedge fund industry. Computer-driven funds betting on market trends and macro managers trading interest rates and currency moves are among those reaping large gains this year. So basically your Citadels of the world, right? Your Virtue, Citadels, Goldman Sachs, the market makers, obviously they're going to do well. They scam you on your trades. Of course they're going to do well. But it says, but in equities, many hedge funds have suffered from a vicious sell-off in high-growth tech stocks as central banks move to tighten monetary policy. Such companies' projected earnings were flattered by ultra-low borrowing costs, but have lost appeal as the Federal Reserve and international peers raise interest rates to curb inflation. A Goldman Sachs VIP index of favorite equity positions taken by hedge funds is down 23% this year. Among those suffering losses have been Chase Coleman, a high-profile so-called Tiger Cub and protege of Tiger Management founder Julian Robertson. Coleman has now lost 52% in his Tiger Global Fund this year, said a person who had seen the numbers. Fellow Tiger Cub Lee Ainsley, who now runs Maverick Capital, is down more than 34%. Dan Loeb's $7.1 billion Third Point offshore fund has lost about 14%, while his leveraged $2.9 billion ultra fund has fallen 18.4%, according to documents sent to investors. Boston-based Whale Rock Capital, which focuses on tech, media, and telecoms, has lost 33.8% in its portfolio, containing both companies and both listed and private investments. Tiger Global, Maverick, and Whale Rock declined to comment. Third Point did not respond to a request for comment. Long-short equity hedge funds take bets that individuals will either rise or that individual stocks will either rise or fall in price. However, stock markets tend to rise over the longer term. The funds often give greater weight to bets on rising prices, so-called longs, than on falling prices, known as shorts. During the protracted bull market of recent years, which was turbocharged during the pandemic, as central banks and governments injected massive stimulus into markets and the economy, funds found it far easier to hold long positions than to hold shorts. And it says that stance was profitable when markets were rising, but now some funds have been left badly exposed on growth stocks that have entered a bear market, adding to concerns about managers' ability to protect investors' cash during tough times. Quote, equity long-short is facing an existential crisis. Stock selection has been poor, shorting doesn't work, and people jumped off the tracks after the train already hit, said Andrew Beer, managing member at U.S. investment firm Dynamic Beta. Quote, even longtime investors are wondering why they're paying managers high fees while bearing all the risk, he said. Investors pulled $9.8 billion from long-short equity funds during the first 3 months of the year, according to data by Group eVestment. Among other hedge funds hit this year is New York-based Select Equity Group, which lost more than 11% across two portfolios that it total manage about $10 billion in assets. And it goes on to say a couple other things as well. Actually, we're just going to read the rest because we're pretty close. It says, among other, read that, New York-based North Peak Capital is down more than 28%, and the Brummer and Partners Manticore Fund is down almost 13% for this year, according to numbers sent to investors. SEG, North Peak, and Contour, which manages the Brummer Fund, did not respond to a request for comment. Funds betting on U.S. equities cut the difference between their long positions and their short positions to close to its lowest levels since 2010 last month, according to a client note from Morgan Stanley's prime brokerage, in a sign of caution, although they have been building this up again in recent weeks. Not all equity managers are struggling. James Hanbury at London-based O'Day Asset Management has gained 8.1% in his LF Brook Absolute Return Fund this year, despite holding positions in Russia that were written down to zero or near zero, according to investor documentation seen by Financial Times. Hanbury has been helped by positions in the energy sector and a bet against former meme stock favorite AMC Entertainment. You can't bet against AMC. That's a bad bet to bet against retail investors and to bet against AMC stock. It's a bad bet in my personal opinion. Now, let's take a look at who is making those bets. What the short interest looks like. 22.44%. Now, we just had short interest estimated at about 24%, so it's very hard to say. Now, I will tell you right now that the actual short interest is much higher than that if you include the put activity that we have seen on the option chain, and it's virtually all puts besides this weird January 19, 2024 $90 call. I think that's very bullish, only for about $45,000, but that is ultra bullish. But over the past week, look at these numbers. These are numbers you typically don't see even on AMC stock. 89 orders totaling $20.69 million, positive order value of 9%. You typically don't see this kind of negative sentiment on the option chain too often on any stock, but let alone AMC, typically does not happen. So that's causing a lot more of those market maker shorts that can be a lot more fluid and can come and go on a daily basis. And that's why you can actually see weird drops or pops in AMC's share price. It's because of hedge funds purchasing close to the money put options or close to the money call options. Now, if we look at the other data as far as the short interest on AMC stock, 115.67 million shares are sold short. Cost bar minimum of 3.14%, cost bar average of 18.11%, cost bar max of about 26.21%, 100% share utilization, days to cover at 3.67, the free flow out on loan at 37%. So you've seen the short interest come down, but the free flow out on loan is remaining the same. You got to take these numbers with a big grain of salt, because I think it's obvious here that the short interest is much, much higher than that. Now, something that might be exciting for some people, hopefully it's exciting to you, is the max pain. The max pain for last week was $13 per share. We closed almost at $13 per share. We closed at about, let's go ahead and pull up AMC. I thought I had AMC pulled up right here. Oh my gosh. Apparently I can't type. But AMC closed at about $12.50 per share, so close enough to 13. Now for next week, the max pain, $18 per share. So that is definitely a good thing, and that would suggest a move to the upside. I will tell you, on the Stonko tracker data, you have a lot of puts that are in the money, which we know puts go into the money, market makers short stock. Well, when those puts go out of the money, the market makers no longer want to have those shorts because they want to stay delta neutral, and then they'll go ahead and buy stock on the open market. So potentially could look at a gamma squeeze in a weird way because of how many calls that are out of the money, but also how many puts that are in the money. Both of these can contribute to potential buying power. So you're looking at about 32.7 million shares potentially would have to be bought by the market makers on the call side, and about 12 million shares on the put side. So looking pretty good right there. About 7,000 calls that are currently in the money. Very, very low number. And then for July 15th, it even looks more bullish. 375,000 calls that are out of the money and 8,500 calls that are in the money. So there's definitely a potential, and I think a high probability, that we will see a move to the upside, possibly this upcoming week, if not over the next couple of weeks. We do have the Fed meeting on Wednesday. You also have some other data that is coming out as well over this next week. So that's going to be the main driver of what's going to happen in the markets. Now, it's hard to say, but I do think there is somewhat of a negative skew around the Fed. I think we could sell off into Wednesday, and then we might actually see a pretty big bounce on Thursday or Friday, as long as we don't get surprised with any new information. Now, as far as AMC stock, why I think it's so interesting right now where we're currently at is because we have seen volume kind of all over the place, right? As volume was just slowly dropping back here throughout the end of April, the beginning of May, the stock just trended down off of that lower volume, right? Which typically should happen. Well, now you've seen volume pretty much back and forth, but kind of trending back down again, but the stock is remaining ultra flat. We've went up and down, but we're staying really in between $12 and $14 per share. So I think that's very interesting. I think it is a very bullish sign that you're not seeing a lot of outright selling from holders of stock. I think the sellers are really gone at this point, and I think the market maker shorts have really taken over in a big way, as well as just the hedge funds that are shorting the stock. Now, the MACD is still bullish, also something that is very, very interesting. Usually does not happen this long. And then the RSI is at 45.48, also on the oversold side. The key levels to watch for the upside, that's $15.24 per share, and then $16.42 per share. That's the 50 and 100-day moving averages. If we break out above that, maybe this week, maybe next week, maybe the week after that, whenever it is, then you're probably going close to this 200-day moving average when that happens, and that's sitting at about $26 per share. I think you'd see something similar that we've seen this time around, right? Broke out above the 50-day, went straight to the 100-day, went straight from the 100-day to the 200-day, got rejected, and then came back down. So that's kind of what I'm looking at, liking what I'm seeing. But that's really going to be all for this video. That's what you guys need to know. I think it's very encouraging overall, that we're in a much better place now, to potentially see margin calls than we have been over the past year. So that is it. You guys get your free stock down below in the description. If you guys want to come trade with me live in real time, join a community of over 100 traders. Check that out, link down below in the pinned comment. Thank you guys for watching. Enjoy the rest of your weekend, and I'll see you in the next one.